Good morning, this is Jeff Hildebrand for TBL Traders. Today's video is going to be on trading the VIX and some comments on margin requirements with your trading. The VIX, let's start quickly with what it is. Most of you have heard of it. It's a popular measure of implied volatility of S&P index options. Investors, traders take it as a sentiment, a good measure of market sentiment. That seems to be relatively true. At least it's inversely correlated to the S&P fairly well, at least on a medium and long-term basis. To point this out, this is the VIX. These candles are the VIX. As the VIX declines here, relatively steadily, first week of June, the S&P, this here is the ES, rises inversely correlated. Keeping that in mind, this can be a good hedge. This product can be a good hedge. Recently had a hiccup. The S&P has started to pull back a little, and the VIX, as you see, has taken off. These behaviors, the VIX behaves rapidly. Keep that in mind. It's also a dangerous product to trade. I use that word dangerous too often. It can have it can pop and drop really quickly. So this is almost a 10% drop in the value here and a 10% pop in the value here. So if you're not especially careful with the VIX, you can find yourself taking larger risk than you plan to, or getting caught with margin problems. I'm going to talk just a little bit more about the VIX because the VIX has other products. It's a futures product that you'll be trading basically. But VIX options are also available. They were released, I think, in 2006. If you're listening to this video, you're probably not trading VIX options. The exercise style is European, meaning they have to be exercised at expiration date. There is the possibility that you might be trading or thinking about trading VIX ETFs or ETNs, that correlated ETFs or correlated ETNs. I would strongly suggest you avoid them. The correlation to the spot VIX isn't great. It's sold as being good, but it's not really very good. There's a ton of financial engineering going on behind the scenes for those products, very similar to the double short, triple short ETFs that track the S&P. They also have similar problems, and I don't personally like all the financial engineering that's going on behind the scenes. I'm sure there's somebody making a ton of money on those products, but I don't believe it's the independent trader. If you really want to trade the VIX, trade the VIX. This is the first video we've done on trading futures. If you're not used to trading futures, don't start with the VIX. Start with the S&P or an index before you start trading the VIX. Why? Because the VIX is in principle range bound. If I took this chart out to a few years, see if I can do that quickly. Obviously the VIX won't go to zero. It's a measure of volatility. Let's take it out to a year and see what we see. Well, the overall trend over the year has been down, but a VIX at 20, I'm not sure I can show you a 5-year. Let's see what the max daily shows me. You see that the VIX won't go to zero. It's a measure of volatility, and it won't go to 200 because it just won't. I know that didn't sound very intelligent, but the VIX is range bound, and that creates a different sort of behavior for the VIX. So if you're new to trading futures, trade an index first. Use the VIX potentially as a hedge, or the inverse. Start trading the VIX and find a hedge with the S&P index. Again, this range, the change here between the 11 and the 13, and between the 13 and 11, might have created some problems. So let me move to margins for a bit when you're trading futures. Margins are created or defined by the option exchanges, in this case the CBOE, Chicago Board of Options Exchange. You'll find on their site the initial margin requirement and maintenance margin requirements. They also have created formulas to define spreads, because obviously if you have a spread, the margin requirements will change. This is not as important to you, but you should just be aware that CBOE publishes this for your particular broker. The brokers are similar. I use Interactive Brokers for a lot of my option trading, but not so much my future trading. In any case, here are the intraday initial, maintenance, overnight initial, and overnight maintenance margin requirements from Interactive Brokers. You can see the difference. I can't really explain to you why. See there you have June $2,860 for the initial. I have $3,250. I think that's just a measure of security for the brokers. They're unlikely to be lower than the CBOE. That's probably the legal requirement. But in any case, keep those margin requirements in mind. Why? Because you'll need to know, if you're trading futures, what happens as your futures move up and down. I use a table for all the products that I trade. I don't have to keep a whole lot of them. I don't keep, those are the initial maintenance and overnight maintenance numbers that I just told you about. But what you need to start with basically is to understand the leverage and the multiplier that's associated with the product. The Nikkei is 5, 10-year U.S. bonds 1,000, the ES, E-mini S&P is 50, NASDAQ is 20. So the futures multipliers are different. Okay, what does that mean? That means if today I have the VIX is at 1310, so let's say just I buy VIX future for 1310. My nominal value is 13,000, and today the VIX goes up to 14 and I sell. I have a $900 profit and loss. That's not a huge swing between 1310 and 14. You see these swings often between 12 and 13. Full point spreads, full point swings on the VIX are not rare. Sometimes you'll see greater 2 or even 3 point swings on the VIX. With the leverage, that makes for a large profit and loss. And that's why you have to keep in mind your margin requirements. If you're trading with a small $10,000, I would say, account, futures trading account, and you try to buy 3 contracts and the VIX swings 1 point, just on a napkin, that's $3,000. You've blown out you're going to get a margin call. Okay, and it's as simple as that. I'll go back. We can go. Keep in mind the other video that I've done on risk management. I don't trade greater than. I keep 2% as my risk level. Futures trading. If you haven't learned how to hedge futures contracts with either options or with correlated futures contracts, you're going to have a problem with your margin, with your account value. So be aware of how this works. I can go over it again quickly. This is your initial account. So if you have a $10,000 account and you buy a contract, they expect that you have at least $3,250 in it. If you try to add to that futures contract because it's rising, for example, you can add 1. You will get stuck when you add 2 if you have a $10,000 account, because the swing will take you out of your limits. I hope that helps. If you have any questions, this video lasted a little longer than I expected, but if you have any questions, let me know. Thanks.